Oh, basically, yeah. Oh, the Panther guy, right? He'll do 2-2 in the third. Oh. He is. I was thinking he was on the he was there. I saw him the other day. He wanders around the hall.
Okay, folks, I guess others may come in as we move on. I do have your test graded. You will see your grade before class is over. However, I'm not going to broadcast. I go for test. So for the first 45 minutes, we'll have class on chapter 4. And, Johnny, were you going to take the test on the first chapter? Or were you going to wait till chapter 2 done? Now 2 done, okay. So a lot on test 2, so get ready for it. And so the rest of you may be putting a lot on test 2 also. We won't count it up. We'll see when you get your grade. Okay, so and you'll get those today. I don't have a grade on them. I've got all the minuses. You'll be adding up the minuses and putting a grade on it yourself. Okay. But now, sitting gauge, I hope all of you have a good start. How many of you have finished chapter 3? All right. If you have finished all of your chapter 1, 2, 3, I'm going to give you a 5-point bonus on the test today, but you have to have it done today. Okay. I looked at those yesterday, and some of you done real well on the same day. Now I can. Now, I don't know if you've noticed or not, but you two were working on chapter 3. We're working on problem 32. Your numbers are not the same thing as your numbers. You know that? Okay. So nobody has the same. You can't get somebody else's answer. You can't. Okay. So same gauge, you have to do it on your own. But anyway, I looked at the time. They didn't give me the time you spent on that chapter. Did somebody actually put 8 hours on a chapter?
I wonder if it counts the time like you started, you go back the next day.
It counts all that, yeah.
Oh yeah, I probably did that too.
I noticed 3 or 4 of you up to 8 hours on a chapter. Okay, and some of you spent 15 minutes. And you settled for a 40. Okay. These people spend 8 hours settled for a 99. Okay. Everybody has the same opportunity. All of you don't have the same time. I had a little lady in class one time. She was probably in her early 40s. And she was a cook at one of the elementary schools in the county. So she wanted to change her career. So she started majoring in accounting. And she took taxes once. I think she got a C. She wasn't learning better, and she took it over a B. There was another class she got a C in, but she wanted to learn better, she took it over. She had to drive over some mountains to get to class. So it took her an hour and a half to get to class. She had a son. She had a husband dying of cancer. But she got her accounting degree and started keeping books for one of the motorcycle sales. And she was not doing much over minimum wage at that job. But she went on and got some other degrees. She almost had her computer science degree, so on. But she got to learn computers along with accounting. So she picked up a code company, and she picked up 2 coal companies, so she started being self-employed. And she was making about $40,000 a year. This was over 20 years ago. So 35, 40,000 a year, moving up from minimum wage was pretty good, right? She even took some classes like Japanese bunk or whatever that is, and she even taught it for the college. But her husband died of cancer at this time. She drove an hour and a half to work, never missed a class. She kept wanting to take other courses, do degrees, and so on. So, always felt like that lady can do it, anybody can do it. But when she learned computers well enough, she still had those 3 coal companies making about $40,000 a year, but she did her work 2 days a week. So with computers, it cut her time down from 5 days to 2 days. So those 2 together, so $40,000 a year for 2 days a week, not bad, is it? Okay, especially 20-some years ago. But that woman was motivated, and she had troubles like many of you all have. I've had students that are going through divorces. I've got one student now, she's about ready to graduate, but she's went through everything. Back surgery, to knee surgery, to divorce, the whole works. So, and nobody in here has kids, right? I mean, you have one. All right. But a lot of people have kids. Kids have sickness and so on. But this lady made no excuse. Her husband was dying of cancer, and she was motivated. So hopefully, some of y'all get motivated like that and do 8 hours on a chapter if you have to instead of 15 minutes. Okay. All right, chapter 4, folks. New material, new information. We want to look at the accounting flow. We want to look at the accounting cycle, and we want to look at closing entries. That's some of the big things in this chapter that we need to pick up. Now, if you learned chapter 3, chapter 4 is easier because chapter 4 has a lot of adjusted entries in it. All right, chapter 4 has all the statements in it. Okay. So chapter 4 is a whole lot of repeat, with closing entries being the new item in the chapter. All right, now this is a spreadsheet. A spreadsheet out in the real world is not necessary. You may have to do an adjusted trial balance. With that adjusted trial balance, you do your other 3 statements. All right, but to do that adjusted trial balance, you got to make your adjustments at the end of an accounting period. Now, an accounting period is a year usually. It doesn't have to be a calendar year, January 1 to December. It could be a fiscal year, FISCAL. A fiscal year, like the state of West Virginia, I don't know when their new year starts, probably July 1st. Federal government somewhere in October, November. So fiscal years start for corporations. Some of them may want to end theirs March 31st. And sometimes it depends on when they start. All right, so we'll be looking at adjusting entries again. We'll be looking at the statements again. And on your test, hopefully you knew to put revenue and expenses to do an income statement. Hopefully you knew to bring this information over to do your capital statement. You have to have ending capital to do a balance sheet. Now on this one, it's called a classified balance sheet because we break down the balance sheet into current assets and fixed assets, which is property, plant, and equipment. Current assets are cash, supplies, things you use, things you can liquidate. Property, plant, and equipment are real assets, fixed assets, long-term assets. They last longer than a year or an accounting period. And of course, if we got liabilities, we might break those down into short-term and long-term. We can skip some of this because we'll be looking at it and doing it. Real quickly, anybody indicate whether each account would flow into the income statement, equity, or balance sheet. So where would you put office equipment? What statement? Balance sheet. Utility expense. Income statement. Accumulated depreciation. That's the balance sheet. Now remember, accumulated depreciation is an asset, but it's a funny asset. It has a credit balance where all assets supposed to have a debit balance. It's called a contra asset. It's subtracted from whatever asset it represents. This would be subtracted from equipment to give you book value. Where does unearned rent go? Balance sheet. It's a liability. Where does Doug Johnson drawing go? Owner's equity, but that's the capital statement. Or owner's equity statement, whichever one they call it. That can be called a capital statement or statement of owner's equity. How about rent revenue? Income statement. How about supplies? How about supplies expense? Okay, so now you got your asset supplies, you've got your income statement item, supplies expense. All right, the income statement, you may have more than one revenue. You may have many, many expenses, and that's all an income statement is. And here your answer is 7105. That's close to the answer on your test. I believe it's 71 something. Statement of owner's equity. So we'll probably have these statements again on the second test. That's why I can count it double. Okay, statement of owner's equity in good form. Now, many times you have a beginning capital and investment or one or the other. All right, and then you add net income and you subtract drawing and you've got ending capital. You've got to have ending capital because it's transferred over to the balance sheet, which would be down here somewhere. All right, classified balance sheet. Current assets, property, plant, and equipment. Liabilities, short-term, long-term. Here we only had short-term. Liabilities always have as a payable except unless you have an unearned. All right, these current assets, you can convert them into cash by selling them or using them. And that's cash, accounts receivable, notes receivable, supplies, prepaid insurance, prepaid rent, any other prepaid item. And fixed assets. These are called fixed assets or plain assets or long-term assets or property, plant, and equipment. All right, current liabilities, accounts payable, notes payable, wages payable, interest payable, unearned fees. Long-term liabilities, if you have to pay it for more than a year and a day. A year and a day makes it a long-term liability. All right, now what are these? Are these current assets, A, property, plant, and equipment, B, current liabilities, C, long-term liabilities, D, or owner's equity, E? So, what's capital? Owner's equity. Notes receivable due in 6 months. Current asset. It's a receivable. Notes payable due in 10 years. Now, if this was notes payable due in 6 months, it's a liability. Notes receivable, it's an asset. Land, property, plant, and equipment, cash, unearned rent,
Current loan.
current liability, yes. Accumulated depreciation, assets, under property, plant, and equipment. And accounts payable, okay. That's just classification of items. And here's the answers, but now, permanent accounts. Your balance sheet accounts, assets is equal to liabilities plus owner's equity are called permanent accounts or real accounts. All right, that means when I start January the 1st, 2019, I hope I've got some assets, right? And I probably will have liabilities if I've been in operation long. I hope I have capital in the business. If not, I went bankrupt. So these are called real accounts. They stay on your books. You start the next accounting period with their balances. Now, temporary accounts, also called nominal, these are revenue and expenses. January 1, 2019, we have zero in revenue. We have zero in expenses. Okay? So how do we get rid of their balances? We do closing entries. It's called the closing process. Now, expenses has what kind of a balance? A debit. Get rid of it, we'd have to do what? Now, revenue has what kind of a balance? Get rid of it, we have to do what? Drawing has what kind of account? Balance. Get rid of it. There's your 3 temporary accounts: revenue, expenses, and drawing. 3 permanent accounts: assets, liabilities, and capital. All right, these are T accounts. I'd rather have journal entries. Here's the journal entries. We debit fees earned and rent revenue and credit all the expenses. The difference we put into capital. Because we know revenue minus expenses is what? What's revenue minus expenses? Net income. So this is net income. The credit to capital. It increases capital. You add it to capital on the capital statement. Statement of owner's equity. And then, of course, we debit capital and credit drawing. Drawing reduces capital. All right, so we will need to learn these 2 closing entries. That's better than the old edition of this book that made it into 5 closing entries, and they made up a dummy account called income summary. I like the way the author is doing it in the new process. 2 journal entries. So those are 2 you'll need to learn from chapter 4. I'm sure, has anybody started, Margot? Revenue, expense, drawing. Are temporary. And you close them out. The other 3 go on the balance sheet: assets, liabilities, and owner's equity are permanent or real accounts. course, here you just have some ledger and excuse me. Now here, your office equipment has 1,800 and your accumulated depreciation has 50. So that would be a book value of 1,750. Excuse me. Now, when you post to these ledgers, we'll get down to expenses, and we have a debit balance of 4525, and we post that closing entry, we'll have a zero balance. We'll have a zero balance, 3 temporary accounts: revenue, expense, and drawing. All right, take a minute and do this. On plain paper, do me 2 closing entries for what you see. We'll be handing out the first half of your test. See? Don't mean anything until we get the rest of it. The amber ball's not here today. Corey. Glenn. There's his live stream this morning. Kelly. Oh,
Yes, sir. Which one?
Robert.
Right.
Oh. Joshua. Heather Alexander. You up front. Marco. Ryan. Jacob. Jeff.
No.
Bob Harris. Oh. Amber Ball is not here. Okay. Alpha. Okay. Pronounce it last name. Webb is not here. Courtney is not here. All right. 4 or 5 that took the test is not here. You'll get the rest of your test in a few moments. Right now, closing entries, 2 closing entries. You should be debiting fees earned, crediting all your expenses. Put the difference into capital, which is net income. Then you credit drawing and debit capital. Does anybody have the net income yet? How much?
I got 41,000.
Well, we'll see if somebody else gets 41,000. Okay, for sake of time, here are the two entries. And the net income is 41,000. Okay, so you debit your revenue and credit your expenses. Net income increases capital like it does on the capital statement. Drawing decreases capital like it does on the capital statement. But you got to make your ledger come out. That's why you're making these two entries. Now, when you post these, you'll have zero balance in all of them, except capital, of course. Capital is a real account. The rest of these are temporary. Then you've got to do a post-closing trial balance. And post-closing trial balance is what's left. Assets, liabilities, and capital. Those are real accounts. That's what's left. Now you take this post-closing trial balance and you start over January the 1st. Now these are already in your ledger. This should be your balances in your ledger. But you're ready to start January the 1st. If you want to start new ledgers, you'll put these amounts in them. All right, here's the accounting cycle. We made journal entries in chapter 2. We posted in chapter 2. I didn't spend a lot of time on posting. The computer does it for you. We have had to post in Cengage. Okay, other than that, we didn't drill on posting. I didn't test you on posting. All right, we did this in chapter 2. Unadjusted trial balance. In chapter 3 and 4, we do adjustments. Chapter 4, we'll do that spreadsheet, 10 columns. Now, chapter 3 and 4, we do the adjusted entries. Even though you got them on the spreadsheet, there's a worksheet, you got to put them in a journal. Adjusted entries have to go in the journal to make your balances correct when you post them. Chapter 3 and 4, we do an adjusted trial balance. All right. Chapter 2, 3, and 4, we do statements. The 3. So the first 8 steps we've done. So the only 2 new steps are the last 2. Closing entries and post-closing trial balance. Some companies use an 11th step called reversing entries. This book doesn't do reversing entries on some of your adjustments. All right, after this chapter, you have finished the accounting cycle for a service business. And you should be able to keep books for a service business. Okay? We know a service business is maybe a small tax office, accounting office, maybe even a doctor, your beautician, your barber, whoever offers a service. Here's the steps again. Okay, can you look at that real quick? We got 8 steps. Can you tell me what 2 steps are missing? Can anybody see what 2 steps are missing? Margot?
One of them just trial balance.
All right. One of them is all right. Was it step 4?
Seven.
Step what?
Step 7.
Oh, the adjusted trial balance, right. All right. One more missing. Step what? An unadjusted trial balance is prepared. So it left out your 2 trial balances, unadjusted and adjusted. Good observation, Margot. All right. In the accounting system, we have a chart of accounts, journal entries. I was called up on by the Board of Supervisors, set up books for PSA. PSA is Public Service Authority. Now, I had to make up my own chart of accounts. Now, in a public, a governmental accounting system, instead of accounts receivable, I had grants receivable. PSA was getting grants from the federal government. So I set up grants receivable. And other accounts. Now, I set up one main set of books with 7 subsidiaries. There was PSA offices at 7 locations in that county. So I set it up where there was a home office with 7 subsidiaries. At the end of the year, you combine 7 subsidiaries to get revenue and expenses. Because each area had revenue and expenses. But you could have done an income statement for each one of the 7, seeing which one was losing money or making money, okay? And if you pay a water bill, you know, PSA probably makes money, don't you? If that's where your water comes from in your county. Somebody said Concord College closed down for the next 2 days.
Yeah.
Why?
Storm preparation.
What?
Storm preparation.
Storm preparation.
The governor shut down all construction and is considering shutting down northbound highway.
You shut down construction on 77, right?
Yes. As the counties or the states of South Carolina, and Virginia prepare their mandated evacuations.
Well, I think we might get some heavy rain.
We'll get 6 inches of rain. What?
What?
We'll get 6 inches of rain. What?
Might have some flooding. So, but close college 3 days before it happens, whatever. Anyhow, we're here. Okay, chart of accounts, journal entries, unadjusted trial balance, end of period spreadsheet, adjusted entries, adjusted trial balance, financial statement, closing entries, post-close, and ledger. These are not in order. Chart of accounts, we know what that is. It has all 6. It has assets 1, liabilities 2, capital 3, drawing 4, revenue 5, expenses 6. That's all 6 accounts in a chart of accounts. We make journal entries, and we posted cash as a debit to the ledger. And this would be probably posted reference. Cash account had number 11. more journal entries, which you've done. The unadjusted trial balance, you had a couple of questions on your test from this unadjusted trial balance. Is this correct? That's not you? Did you take the test? Not familiar with yet. All right, but anyhow, get your leg hurt playing basketball?
Yes, sir.
Not for the season, is it? Yeah. We hope not. All right, unadjusted trial balance. You had questions. It proves debits and credits. I think there were some of the errors on there that you could mention. Excuse me. 6 columns of the 10-column worksheet. Adjusting entries. You can put them on the worksheet first or put them in the journal first. It wouldn't matter. Ordinary adjusted entries, some of you had trouble with on the test. We adjusted prepaid insurance. We adjusted supplies. We brought depreciation up to date. We adjusted what we owe for salaries. All right. Rent expired was another prepaid item, just like prepaid insurance. Insurance, supplies, and rent were all prepaid. Here is your unearned fees adjusted. Excuse me. Then you do the adjusted trial balance, then the statements. Now, when you got this adjusted trial balance, you should easily see your revenue and expenses and do an income statement, right? You can easily see all of your assets. Well, you can see your drawing and your capital. Take that and your net income and do a capital statement, then everything else goes on a balance sheet. And then 2 closing entries. Fees earned, credit your expense, net income is $18,300. Another way you subtract there. What's your net income? $18,300. That's what you're putting into capital. Then your post-closing trial balance, that's your permanent accounts. These accounts normally don't have to go here, don't need to. Your ledger, zero balances in your temporary accounts. Now, I told you a fiscal year can be any 12 months. Any 12 months. If a corporation starts 1st of April, then they can end their year April 1 to March 31. Okay? When a corporation adopts a fiscal year that ends when the business activity has reached the lowest point in its annual operating cycle, it's called the natural business year, whatever their fiscal year is. Financial history of a business. And you know, if a business doesn't keep proper records, keep these items, it will go bankrupt. It will fail. Okay. How liquid is a business? It depends on their current asset. If they have the ability to pay their debts, they're solvent. If not, they're insolvent and bankrupt. Now, working capital, WC, equal to current assets minus current liabilities. Now, WC, some people get terminology wrong, or terminology is different, sometimes for different people. Who has had economics? All right? Your four factors of production is land, labor, capital, and entrepreneurability. All right, capital in economics is machinery and equipment. You take land, labor, land is your raw materials, whether it be timber, whether it be coal, gold, oil, that's your raw materials, land. And your labor and your machinery, take entrepreneurability and put those together, and you got a business going. Okay? But in accounting, we know that capital on the capital statement is the owner's investment, right? It's money. So WC, my international students last night knew what I was talking about. From Europe. A WC in Europe is a water closet. What is a water closet? It's a toilet, restroom, bathroom. WC. But there was an old farmer out in California who went to sell his ranch. And somebody from Europe came over and looked at the ranch, and he liked it. This was back before the day of cell phones, text, email. I believe there was faxing. Okay, so faxing, I think, started first. So the old guy in Europe, he faxed back to farmer and said, I looked over your ranch, I liked it, I'm interested in buying it, but I did not count the WCs on the property. Now, the fellow in Europe meant bathrooms, right? I did not count the WCs on the property. Well, the old rancher in California, he didn't know what it meant by WC, but he said, we have one 10 miles down the road. It will seat 100 people. All right? He said, my daughter got married there 2 years ago. Now, how would you like to have a bathroom to seat 100 people? Your daughter got married there. And once a year, we have a community-wide picnic at our WC. See, the old rancher out in California, the WC to him was a wayside chapel. Okay? So water closet, wayside chapel, but in accounting, it's working capital, okay? All right, working capital, just take your current assets minus your current liabilities. And the 6355 is what you have left to pay debts with. Current debts or new debts. Current ratio is current assets over current liabilities. This ratio is way too good. If it's over 2, it's good. All right, here is the spreadsheet. We'll look at that later. And here is the thing called reversing entries. It is mentioned in the book. Okay, in order to go over your test and get a grade on it, I'm going to stop live streaming.